Here's what nobody tells you about your annual review. You walk into that conference room, your manager slides the paper across the desk, and there it is, 3%. You smile, you say thank you, you walk out feeling like you just won something. But here's the thing, you didn't win, you lost. And the company knows it. They've known it for decades. Because while you were celebrating that 3% bump from $70,000 to $72,100, inflation was running at 4.1%, which means in terms of what your money can actually buy, you just took a pay cut of 1.1%. You're broker than you were last year. And next year, you'll be broker still. This isn't an accident. This is the system working exactly as designed. And Gen X, the generation that played by every single rule, worked every late night, skipped every vacation day, they're the first ones to figure out they've been running on a treadmill that's been tilted backwards the entire time. So here's what I'm going to show you. Why your annual raise is actually a wealth extraction mechanism disguised as a reward. How the math behind corporate compensation is designed to make you poorer while making you feel grateful. And why the people who figure this out earliest are the ones retiring on their own terms while everyone else is still waiting for that promotion that'll finally change everything. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. All right, let me give you the central metaphor that'll make this whole thing click. Think of your salary like a hotel room price. You book a room in 2015 for $120 a night. That's your starting salary. Now, every year, the hotel tells you, good news, we're raising your rate by 3%. So in 2016, it's $123.60. 2017, $127.30. You're paying more every year. And the hotel makes you feel like they're doing you a favor by letting you keep the same room. But here's what they're not telling you. The room next door, the identical room, is now going for $145 a night for new guests because that's what the market actually bears. You're sitting in your room, proud of your 3% annual increase, while the guy who just walked in off the street is getting better terms than you because he negotiated fresh. This is your career. The 3% raise isn't keeping you in the game. It's the minimum amount they can give you to keep you from looking at what new hires are getting. Let me show you how this plays out with real numbers, because the math here is where the lie lives. Let's say you start a job in 2020 at $80,000, solid middle-class salary. Your company, generous company, gives you 3% every single year. By 2026, you're making $95,412. That's $15,412 more than when you started. Feels good, right? Except inflation over that same period averaged about 4%, which means just to maintain the same purchasing power you had in 2020, you'd need to be making $96,665. You're short by $1,253. In other words, despite getting a raise every single year, despite being more experienced and more valuable than you were 6 years ago, you can afford less than you could on day one. You're not climbing a ladder. You're sinking in quicksand at 3% per year. Now you might be thinking, okay, but that's just unlucky timing. That's just the inflation spike from 2021 and 2022. And look, fair point. So let's run the numbers for someone who started in 2010, before all the craziness. Same setup, $80,000 starting salary, 3% annual raises, compounded every year. By 2026, they're making $121,741. That's a 52% increase over 16 years. Sounds impressive until you realize inflation over that same period was about 38%. So in real terms, after 16 years of loyal service and 16 consecutive raises, they're only 10% ahead in purchasing power. 10% over 16 years. That's 0.6% per year. That's not a career trajectory. That's a rounding error. And this is exactly what Gen X is waking up to in their late 40s and early 50s. They did everything right. They stayed at companies. They were loyal. They got their annual merit increases. And they're looking at their bank accounts, wondering why they feel broke. But here's where it gets really interesting. You think the problem is that 3% isn't enough? That if companies just gave 4 or 5% raises, this would all work out? That's not the problem. The problem is that the entire system is designed around a wealth transfer that happens so slowly you don't notice it until you're 20 years in. Let me explain. Companies' budget for total compensation increases every year. Let's say a company has 100 employees and a total comp budget increase of 4%. That's not 4% per person. That's 4% total across everyone, which means some people get 6%, some get 3%, some get 0%, and a few people get fired to make the math work. Now, here's the trick. New hires get paid market rate. They have to, or nobody would join. So if market rate for your job has gone up 7% in the last 2 years, the new person sitting next to you doing the same work is making 7% more than market was when you were hired, plus whatever your raises added up to. Except your raises only added up to 6%. You're behind. The new hire is ahead. And the company just saved 1% on your compensation versus what they'd have to pay if they let you go and hired someone fresh. Your loyalty is a discount you're giving your employer, and they know it. Let's talk about a guy I'll call Dan, because this is where the theory becomes real. Dan started at a tech company in 2008, making $90,000 as a senior developer. 18 years later, in 2026, after getting an average of 3.5% raises every year, Dan is making $161,500. Dan feels pretty good about this. He's nearly doubled his salary. But here's the issue. Market rate for a senior developer with 18 years of experience in 2026 is $215,000. Dan is $53,500 below market. That's a third of a full salary he's leaving on the table every single year because he stayed put and trusted the system. Now, Dan finally figures this out. He goes on the job market. He gets an offer for $210,000. He goes to his boss, and his boss says, "We really value you, Dan. Let me see what I can do." 2 weeks later, they come back with $185,000. Dan takes it because it's a $23,000 raise and he's tired of interviewing. Feels like a win. But here's what just happened from the company's perspective. They were paying Dan $161,500 for work worth $215,000. They were getting a $53,500 discount. Dan almost left, so they gave him $23,500 more and kept him. They're now paying $185,000 for $215,000 work. They're still getting a $30,000 per year discount on Dan, and Dan thinks he won the negotiation. This is the game. And if you're in your 40s or 50s and you've been at the same company for a decade, you're Dan. You've been giving your employer a discount for years, and you didn't even know it. Here's a psychological shift that happens, and this is what makes Gen X different. When you're in your 20s and 30s, you believe in the myth of meritocracy. You think if you work hard, stay late, hit your numbers, the system will reward you proportionally. You'll get promoted, your salary will track with your value, and by the time you're 50, you'll be in great shape. Then something happens in your mid-40s. You start doing the math. You look around and you realize the VP who's been there for 15 years is making maybe 30% more than the new VP they just hired from outside. You realize your 3% raises haven't kept up with cost of living. You realize your 401k, even though you've been contributing for 20 years, isn't anywhere near what you'll actually need. Because you believed the retirement calculators that assumed 7% annual returns and didn't account for sequence of return risk. And this is the moment. This is when people either get angry and quit, or they get quiet and start planning their exit in silence. Gen X is doing the latter. They're not making TikToks about it. They're not writing resignation manifestos. They're just quietly moving money into index funds, paying off their houses, and waiting for the math to work in their favor so they can walk away from the whole thing. Now, here's the kicker that nobody talks about. Companies aren't trying to screw you out of malice. They're optimizing for their own incentive structure, and your long-term wealth just isn't part of the equation. CFOs get rewarded for keeping compensation costs down. HR gets judged on turnover rates, not employee wealth accumulation. Your manager has a fixed budget and 10 people reporting to them, so they spread the raises around like peanut butter, giving everyone just enough to avoid a revolt, but not enough to actually get ahead. Nobody in this chain is thinking about whether your 3% raise beats inflation. That's your problem, not theirs. And this is why systems thinking matters. When you understand that everyone in the corporate structure is responding rationally to their own incentives, you stop being mad at individuals and you start seeing the game for what it is. A machine designed to extract maximum productivity at minimum cost. Your job isn't to be mad about it. Your job is to stop playing the game on their terms. Let me give you 2 fast scenarios to show you how this plays out in real life. Scenario 1. Your coworker, let's call him Mike, has been at the company 12 years. He's got his 3% annual raises, he's comfortable, he knows the systems, he's the guy everyone goes to when something breaks. Mike makes $110,000. Then the company hires Sarah, who's got 10 years of experience at a competitor. They pay her $135,000 because that's market rate, and she had competing offers. Sarah sits 2 desks away from Mike doing the exact same job for $25,000 more. Mike finds out, obviously, because people always find out. Mike goes to his boss. Boss says, Sarah had competing offers, we had to pay market rate, but you're a valued member of the team. Mike gets a 4% bump as a retention adjustment. He's now making $114,400, still $20,600 behind Sarah. Mike's upset for 2 months, then he gets used to it. That's scenario 1. Scenario 2, different Mike, same situation. Finds out about Sarah, says nothing to his boss, updates his resume that weekend, applies to 20 jobs over the next month, gets 3 offers, takes one for $145,000, gives notice. Now his old company has to backfill Mike at market rate, which is $140,000 minimum. Plus, they've got to onboard someone new, which costs about 30% of annual salary in lost productivity. So Mike leaving cost them $140,000 plus $42,000 in onboarding costs, $182,000 total, when they could have just paid Mike $135,000 to keep him. But they didn't, because the system doesn't reward retention. It rewards whoever's willing to leave. Look, here's the part where someone always says, but Tom, if everyone just job hopped every 2 years, the system would collapse. And yeah, maybe, but it hasn't. Because most people don't job hop. Most people take the 3%, say thank you, and stay put, because switching jobs is uncomfortable, and there's always some reason why now isn't the right time. You've got a kid starting school, or your mom's sick, or you're 6 months away from full vesting on some equity that's probably not worth what you think it's worth. And companies know this. They're not stupid. They know that most people have golden handcuffs that aren't even made of gold. They're made of inertia and fear and the sunk cost fallacy. So they keep giving 3% because 3% is enough to keep 70% of people from looking elsewhere. And that 70% is subsidizing the other 30% who do leave and get market rate somewhere else. It's a tax on loyalty, and you're paying it every year you stay. Here's a fun little dialogue I imagine happens in every HR department. Employee asks, why'd you offer the new hire so much more than you pay me? HR responds, well, the market's changed, costs have gone up, talent's competitive. Employee says, okay, so if the market's changed, shouldn't my salary change too, since I'm already doing the work at a higher level than the new person? HR says, we evaluate compensation on a yearly basis during review cycles, and we take market conditions into account. Employee says, you just told me market rate is higher. HR says, your compensation is competitive relative to your tenure and performance band. Employee gives up, HR wins. Scene. Here's another one. Manager in a budget meeting. I need another $20,000 to retain my top performer, or they're gonna leave. Finance says, is this person actually at flight risk, or are you just worried they might be? Manager says, they haven't said anything, but I can tell they're frustrated. Finance says, then let's wait until they give notice. If we give everyone a raise just because we're worried they might leave, our costs will spiral. Manager says, but then we'll have to backfill at market rate, which is $30,000 more. Finance says, that's next quarter's problem. This is this quarter's budget. Manager shuts up. Finance wins. Employee leaves 6 months later. Nobody connects the dots. So what do you actually do with this information? Because I'm not here to just make you mad. I'm here to show you the exit. 3 things. 1, if you've been at the same company for more than 4 years and you haven't gotten a major promotion, you're almost certainly underpaid. Go look at market rate for your actual skills and experience level, not your title. Use levels.fyi, use Blind, use Glassdoor, whatever. Get the real number, then do the math. If you're more than 10% below market, you need to have a conversation or start interviewing. And I don't mean apply to 2 jobs and give up. I mean, treat job searching like a part-time job for 3 months and see what happens. You'll be shocked at what the market's actually willing to pay you. 2, stop thinking of your salary as a reward for good work. It's not. It's a price your employer pays to keep you from leaving. That's it. Once you internalize that, you stop feeling grateful for 3% and you start negotiating like someone who understands leverage. Your value isn't what your company pays you. It's what someone else would pay to take you away. And 3, build your exit plan now, not when you're desperate. Max out your 401k, not because you believe in your company's match, but because it's tax-deferred wealth accumulation that your future self will thank you for. Get your investment account to a number where you can see the path to financial independence, even if it's 10 years out. Because the moment you know you don't need the job, you start making better decisions. You stop taking the 3% and saying thank you. You start asking for the number you're actually worth. And if they say no, you leave. Not out of anger, but out of math. Here's the thing about Gen X that the younger generations don't fully get yet. Gen X isn't cynical because they're old and bitter. They're cynical because they're the first generation to realize that the social contract their parents had, the one where loyalty got rewarded and pensions were real, and you retired with a gold watch, that contract was torn up sometime in the 90s, and nobody told them until it was too late to adjust. They worked hard, they stayed late, they skipped vacations, they did everything right. And now they're in their 50s, looking at a retirement calculator that says they need $2.2 million to retire comfortably, and they've got $380,000 saved. And they're doing the math on how many more years of 3% raises it'll take to close that gap. And the answer is never. The gap never closes. Because the returns on investment will always beat the returns on labor. And if you're still trading hours for dollars in your 50s, you've already lost. This is why Gen X is quietly rage investing right now. They're not buying crypto, they're not buying meme stocks, they're buying VTI and chill, boring index funds that compound at 8% while their salary compounds at 3%. And in 15 years, the investment account is going to be bigger than the salary ever was. Lazy investing built more fortune than crypto memes. That's not a cute line. That's just math. So let's bring this back to where we started. You walk into that conference room. Your manager slides the paper across the desk. 3%. You've got 2 choices. You can smile, say thank you, and accept that you're giving your employer a loyalty discount that'll cost you hundreds of thousands of dollars over your career. Or you can recognize that 3% isn't a raise. It's a ransom payment to keep you from realizing what you're actually worth. The companies that pay 3% are hoping you don't do the math. They're hoping you don't look at market rate. They're hoping you're too comfortable or too scared or too busy to leave. And for most people, that hope pays off. But you're not most people. You're someone who's doing the math. And the math says move. Not recklessly, not out of spite, but strategically, with a plan, with leverage, and with the understanding that your wealth is your responsibility, not your employer's. They're playing their game. Time to play yours.